Before we begin, let's walk through our webinar platform together. Each of the buttons at the bottom of your screen relate to sections in the ON24 console. The speaker view is where you will see our presenters throughout the webinar. The slide view is where you'll see the accompanying slides. Our poll questions will also appear in the slide area. Be sure to click directly on the slide to answer poll questions throughout the webinar. You can resize these widgets for a larger or smaller view. You may follow along also with a PDF version of the slides that can be found in the related content widget. The CPE criteria section details the requirements you must meet to receive full credit for CPE in this session. To obtain CPE, you must do two things. First, be on the live webinar for at least 50 minutes, and second, respond to 3 of the 4 polling questions that will appear throughout the presentation. You can track your viewing progress in the Earn CPE widget on your screen throughout the webinar. By registering for today's event, you will automatically receive an email after 24 hours with a link to download the slides and a link to view the recording. Additionally, if you meet all the criteria and qualify for CPE, a link to your CPE certificate will be in that email as well. Please remember that it does take 24 hours for that email to be automatically generated, so look for it sometime tomorrow afternoon. For CPE-related questions, please reach out to cpe@yptc.com. In the related content section, you can access any accompanying materials for this webinar. This includes a PDF copy of the slides and many times will often include related resources. Reactions from our audience throughout the webinar will float along the console screen. Use the Q&A section to ask questions directly to our speakers throughout the presentation. In the speaker bio section, you can find more about our presenters, including their contact information. If you need technical assistance, please use the help button below. Many times, technical issues can be resolved by opening the webinar in Google Chrome or refreshing your browser. Finally, the evaluation button contains our post-webinar evaluation survey. Here is where you can share your commentary and feedback on the presentation. We hope you enjoy our free webinar. Now, let's get into today's topic.
Welcome, everybody. My name is Greg Indichter. I'm a director, a part-time controller, and the market leader for our Central New Jersey office. Thank you for joining me today as we go beyond compliance and talk about why your audit and Form 990 matter. Before we get into the topic, let me just briefly tell you a little bit about your part-time controller, or YPTC for short. We are a professional services firm that specializes in nonprofit financial management for over 30 years. Our services include accounting, reporting, data visualization, and best practices, just to name a few. Although, because we are not independent to our clients, we do not perform the audits and we do not prepare Form 990s, but we do help our clients get ready for them. We have a team of over 800 professionals who support over 2,300 nonprofit clients nationwide. And we really tailor our approach to working with clients on site or remotely, depending on their needs. So just a quick reminder before we get started, as the video just indicated, for this webinar, we're using polling questions for attendance checks, and you'll see them appear in the slide window. Be sure to hit the submit button after selecting your answer to ensure that you receive the CPE. And you can track your progress in the Earn CPE widget at the bottom of your screen. Finally, we want to hear from you. So if you have questions during the presentation, please drop them into the Q&A box. Although I may not be able to answer them live during the presentation, I will be staying on for about 15 minutes at the top of the hour to answer those questions. And just one note that Q&A time will not be part of our hour for CPE. All right, so let's jump right into it. And just to set the stage that your audit and the Form 990 is not a compliance or a checkbox activity. These are often the first things funders read before deciding whether to invest in your organization. So in our program today, we're going to explain why the audited financial statements and IRS Form 990 are critical to funders' evaluation and how they might influence those funding decisions. We're going to identify key sections of the audit and Form 990 that funders look at most closely, And then we're going to incorporate some best practices for presenting information on your audit and Form 990 to help build trust and proactively address potential concerns that funders may have. Here's our agenda. We're going to start with the intro of why it matters. We're going to dig into the audits. We're going to dig into the Form 990, and then wrap up with some best practices. So let's start by talking why all this matters. And for funders, your audit and Form 990 aren't background documents. They're really a window into your organization. And decisions will be influenced by these documents well before you ever get a chance to meet with the funder. The good news is funders aren't expecting perfect numbers. What they're looking for is transparency. They're looking for clear explanations that they can trust. And that's exactly what we're going to focus on in today's presentation. So let's talk about why this matters in a little more detail. And the first important point is financial integrity. And this really helps ensure funders that your financial information is accurate, that reduces the risk of fraud, and that it demonstrates strong financial oversight. Next, we have compliance. They want to, these forms confirm that you're meeting the IRS guidelines and other regulatory requirements, and most importantly, maintaining your tax-exempt status. We have program impact. And as you'll see, the Form 990 highlights your program accomplishments. It helps funders understand how their contributions are supporting your mission-driven work. For benchmarking, funders use these documents to compare applicants, looking at things like overhead ratios, program spending, and the revenue mix to assess relative risk and sustainability of organizations. And finally, transparency. The key point here is that both documents are public, especially Form 990. Making them easy to access, for example, on your website, helps strengthen confidence and trust with funders. Funders want to know that you'll be accountable for the resources that they provide, and these reports really help make that clear. So very often your Form 990 and your audit really are that first glance into your organization for funders, really before a conversation ever happens. So starting with the audit, it really confirms that the numbers are reliable and they're reviewed by an independent CPA firm. For funders, that signals strong financial oversight and discipline. Now, completing the audit on a timely manner matters. As for best practices, we always recommend aiming to complete the audit within about 90 days of year end. When an audit is recent, it reassures the funders that everything is well managed at the organization, and leadership and the board is staying on top of its financial responsibilities. Conversely, delays can really raise questions about governance and risk. Funders are typically looking for a clean audit. That's an unmodified audit opinion. There are no unresolved issues, and there's consistency from year to year. And as a important reminder, the purpose of an audit is not for an auditor to review every single transaction, and auditors are not responsible for detecting fraud. What an audit does is provide reasonable assurance, not a guarantee, something that's helpful for both nonprofit leaders and funders to keep in mind. All right, turning to Form 990, it provides a public snapshot of your finances, as well as governance and your mission activities. Funders use this for really as a transparency tool, and they are going to compare it closely to the audited financial statements. Funders want to see alignment with the audit, a clear description of the mission and program spending, and also governance and compensation practices, making sure they appear reasonable. Funders want to see alignment with the audit, which is important, but one thing to keep in mind as far as timing, they may not be issued at the same time, but the 990 Filing 990 timely is very, very important. It's a compliance issue. Late filings or repeated extensions often prompt questions from funders. All right, so let's shift from the big picture to details funders focus on most when reviewing an audit. So this is going to bring us to our first poll question. Remember, please hit the submit button for it to count. So funders use the audit in Form 990 primarily as a tool to assess which of the following. Is it compliance with IRS filing requirements, financial accuracy and internal controls, program effectiveness and governance strength, or D, organizational stability and transparency? And as you vote, think of the thing that's really the overarching answer here. I think one really stands up and the others really roll into that. Just give you a couple of seconds to answer that question. All right, another 10 seconds here or so. The answers are pouring in. All right, let's see what you all think. So it looks like the majority got this right. It is D, stability and transparency. I think the other answers really do roll up into that overall issue of stability and transparency. All right, so we talked about why the audit and the 990 matters. So let's really get into each of these now, starting with the audit. And we're going to look at what funders typically are looking at. And there's four big areas. One is the opinion, next is liquidity, then stability, and then finally red flags. And everything else in the audit really supports these issues. So funders don't read every page in the audit. They're going to focus on key areas to help them assess the financial health, the compliance, and risk of an organization. So first we have the auditor's opinion, and that's obviously the first place they're going to look. It's right at the beginning. And again, they're looking for a clean or unmodified opinion. And that, of course, signals reliability. They're going to look to see if there's any findings or going concerns. If these do exist, funders want to understand what these issues are and really how the organization is going to address them. And then finally, they're going to look to see whether the audit was completed on time, which again is going to hopefully reflect strong financial management. The next thing they're going to look at is the statement of financial position, or the balance sheet. And in this report, they're going to be focusing on liquidity, how much unrestricted cash is available for the organization. They're going to look at debt levels and look at the mix between restricted and unrestricted net assets. Too much in restricted net assets might raise concerns about flexibility or make funders question on how donors' requests are being managed. And perhaps too much in unrestricted net assets might lead the funders to question what the overall funding needs of the organization really are. They're going to then go to the statement of activities and functional expenses. Funders are going to look at revenue sources and to see whether they're diversified. They're going to pay close attention to expenses, how they're allocated, especially looking at allocations between program versus administrative costs. And they're going to look at trends over time. Are there consistent surpluses? Are there ongoing deficits? And finally, they're going to read the notes that accompany the financial statements. And those notes are going to provide some context. That's going to include accounting policies, commitments and contingencies, related party transactions, and even events that occurred after the year end. So let's take a deeper dive into each one of these. So here's an example of an unmodified or clean opinion from an audit report. And as you see, it communicates that the financial statements are presented fairly in all material respects. The timely completion, again, is very important, and the funders are going to look at the date of the audit report to assess that. This will show how current the information is. Now, this date represents when the audit work was completed. This is not the issue date of the report. Now, if something notable occurs during that interim period between when the auditors finish their work and when they finally issue the report, that subsequent event, that will be disclosed in the notes section in the financial statements. Again, best practice is to have your audit completed within 90 days of the year end. So we're going to move on to the statement of financial position. Again, this is a very important report. This really shows the funder the overall financial health of the organization, and that's what they're going to be looking to assess. And they'll do that in a couple of areas. First is they're going to compare current assets to current liabilities. On the statement of financial position, these items are listed by liquidity. So that's assets listed by how quickly they can be converted into cash, and for liabilities, how soon will they be due. Now, current assets are expected to be used or converted into cash within 1 year, and current liabilities are those obligations that are due within 1 year. To assess liquidity, funders often ask, are current assets greater than short-term liabilities? If yes, like in this example, it shows that the organization can cover its immediate obligations. Next, funders are going to review the mix of assets, liabilities, and net assets. They're going to look at what's current versus what's non-current. They're going to pay close attention to debt levels and whether they're both either short-term or long-term debt. So looking at property and equipment, that's obviously not a liquid asset because it can't immediately be turned into cash. But it does show that an investment in property and equipment is supporting the organization, but it also can limit flexibility. Funders are going to look at debt levels and liquidity, and we can see here that they've actually created a little reserve to maintain the building, which is great. That shows, I think, prudent financial management. And finally, funders are going to look how restricted funds are managed. Too high percentage of restricted funds, again, is going to call into question the flexibility an organization has, which is not the case here. All right, just to recap our statement of financial position and what funders are looking for, they're going to be comparing current assets to current liabilities. They're going to be evaluating the entity's composition of assets, liabilities, and net assets, reviewing debt levels and liquidity, and assessing how restricted funds are managed. So let's move on to the statement of activities, or the income statement. Again, funders looking to assess the financial health of an organization. They're going to be keying in on a couple of things here. And first is the change in net assets across each of the column. So a positive change indicates that the organization brought in more resources than it spent. A negative change, especially in the without donor restricted bucket, can raise sustainability concerns, since those funds are used to support ongoing operations. These funders are going to have questions about that. And they're going to be comparing results not just within this report, but for prior periods. They want to develop and see trends over multiple years. As they look at the revenue section, they're really trying to determine revenue diversity. Is there a heavy reliance on a single funding source, such as just one grant or one major donor? That could create some risk. So a healthy mix of earned income, like program fees, and contributed income, like donations and grants, generally provides more stability and flexibility. In this example, program fees income represent about 74% of total revenue. That could be a strength, but funders may also consider how sensitive that revenue stream is to changes in demand or participation in the program. And looking at the donor restrictions, even though it's not the case here, a large balance with donor restrictions can mean resources are tied up and not available for current operations. As I sort of mentioned earlier, or I should point out if I didn't mention it earlier, it's important to periodically confirm that releases from restrictions are in alignment with donor stipulations. All right, so the key points here in when funders are assessing the statement of activity are that there's a positive change in net assets, there's good revenue diversification, and there's manageable balances in the donor restricted net assets. All right, so really talked a lot about bottom line and net income. Of course, the other big number on statement of activities is expenses, and we're going to look at that now. And doing so through the statement of functional expenses. So just a quick refresher course on what this statement shows. It's providing expenses not only by the sort of natural classification, what type of an expense it is, but also by functional category. And nonprofits report on 3 functions. There's program, there's management in general, and then there's fundraising. So program expenses are tied directly to delivering the mission, things like program staff salaries, supplies used in programming, and maybe food and materials for the beneficiaries of those programs. Our management and general expenses really support the organization overall, and that's about oversight and governance. When costs are not directly linked to programs, programmatic activity or fundraising, it's typically general and management. So these could include executive leadership, administrative staff, office costs, and interest. And then finally, we have our fundraising expenses. And of course, that relates to activities aimed at generating contributions such as fundraising events, campaigns, materials, staff and consultants that perform those support efforts. And some organizations might have a 4th column for membership development. That's very similar to fundraising, but that's really for soliciting members or collecting dues as opposed to contributions. And we're not showing that in this example. In addition to the statement of functional expenses being required by accounting standards and by the IRS, functional percentages are closely scrutinized by funders and watchdogs. So it's important that this report is prepared accurately. So these watchdogs are really going to take the functional expenses and try to measure efficiency. But it's very important to keep in mind that context matters, not just the numbers. And we did a program on this and diving deeper into this issue, and you can find this on our website. It's called Understanding Overhead, so it's not over your head. So if you have time, check that out. All right, funders also will look to whether the organization's functional expense mix is reasonable, and they're going to probably compare that to similar organizations. It's not just whether one category seems high or low. Does everything seem reasonable? And is it consistent? Because many costs support more than one function. It could be shared across program, management in general, and fundraising. Nonprofits must document how they allocate shared cost. Common methods include some type of an allocation by payroll percentages or by square footage. And while us accountants, we're going to handle the calculations, the allocation policies themselves, they're going to be developed by management and by the board. I think I had the last. Sorry, I had one more bullet point to bring up. Okay. So funders are going to look to whether the organization's, as I mentioned, functional expenses are seem reasonable. That's the allocation policy. And really, we have two attributes that we look there, that the allocation methods are reasonable to the type of expense, and they're consistently applied year to year. So again, our funders are going to be assessing whether resources are being managed thoughtfully and transparently. So it's not just about efficiency. All right, here we go. So we walk through what funders look for in the financial statements, but they're also looking for some red flags. Not that they're looking for problems, but they just want some assurance that leadership and the board understands when there are issues, that they're aware of them, and they have a plan to address them. So most audits include probably one of these items listed, not all the time, but it happens pretty frequently. And there's nothing wrong with any of these issues. It's just going to probably prompt some questions from the funders. So we're calling these red flags, and they could really be under the category of a sign of ineffective governance or a sign of declining financial independence. We showed some examples. It's all about how we explain these issues if they do exist. So there is another statement in your audit. I didn't show it. It's called the Statement of Cash Flows, and it really speaks to operating liquidity and sustainability. And funders, they may not understand it, but they may infer some things about operating cash flows when they're reviewing that. And they're definitely not going to be doing a line-by-line review of it. But I just wanted to call out that one last statement. All right, so a few takeaways here. If any of these issues do exist, don't ignore them. Address them proactively. Red flags on their own aren't necessarily a deal breaker when soliciting funds from a donor. What concerns funders most is when these issues persist year over year and without any kind of clear explanation or some kind of correction action plan. Your audited footnotes and your Form 990, which we're going to touch on next, these are really powerful tools for providing context to these issues, explaining what's driving them, and communicating what management and the board are going to be doing about them. All right, so this slide really is sort of a guide for interpreting the financial signs funders use to assess confidence and funding decisions. Again, not every single one of these points are directly included in the audited report, but they do really tie directly to sound financial management. So what builds confidence for your funders? Some of these items here, they reflect that the nonprofit has strong financial health. They demonstrate stability, sustainability, the ability to adapt to challenges, all without significant financial strain. What they're really looking at closely, signs here, they may not be something of immediate trouble, but these are maybe emerging financial pressures or uncertainties that could cause a funder to give pause. One item listed here is repeated budget variances. Of course, we're not presenting a budget in our audited financial statement, but maybe a funder may ask about variances after reviewing audit results that are different from the expectations that maybe were communicated. Maybe they had access to forecast or, again, prior communication. So similarly, payment delays aren't disclosed in the audited financial statements either. But funders may infer timing stress when they're looking at things like rising payables year over year, weakening operating cash flows from the statement of financial position or the statement of cash flows, or what's in your liquidity disclosure. So these are indicators that the funders, that may lead funders to question the organization's ability to pay their obligations on a timely basis. And finally, some red flags, again, that might trigger questions from funders. Will the organization struggle to meet its obligations? Are they maintaining, how will they maintain operations? Are they sustainable? Will they be able to keep delivering their mission without corrective action? Again, we talk about restricted donations, restricted net assets here. Keep in mind that restricted net assets can't be borrowed from, even on a temporary basis. So if it looks like the organization is using restricted funds for general purposes, that is going to be a big red flag to funders. And obviously that's not something that a donor wants to see. So we have to make sure that we are not in that practice. All right, so again, as we said before, funders don't expect perfection. What they are expecting is awareness. We're aware of potential issues. They want to see transparency. Are we communicating and providing explanations? And do we have a plan? How do we address any potential issues moving forward? All right, so that's what we will review on the audit. We're now going to turn to Form 990. And before we do that, we have our next poll question. So when this issue appears repeatedly, which is an indicator that's most likely going to prompt the funder to ask some follow-up questions? And again, which one of these responses or these potential issues is the big one? One is the big one, and then the other ones I think are going to be the trailing answers. So let's see, what do you all think? Remember, hit the submit button to get credit for CPE. And I'll give you a little bit to answer this question. All right, about 10 more seconds. All right, the answer, the biggest driving factor is A. Again, I think that funders are going to be questioning that first, and then they might get into some of the ongoing issues of low liquidity, growing debt, and heavy reliance on funding sources. But having late audits and year after year, I think that's going to trigger some hard conversations with the funder. All right. Let's move into Form 990. And we're going to highlight some of the sections that funders are going to typically look at. So where the audit is going to say, are these numbers reliable? The 990 is really going to answer the question of what is the organization's governance and communication. Are they doing that responsibly? So each section of the core forms in the 990, we're going to list here. And they really give funders insight into governance, financial health, and alignment to mission. Funders can also use the 990 to calculate and compare ratios like program versus administrative expenses. And they're going to, of course, check on the consistency with what's presented in the 990 versus what is in the audited financial statements. So the first thing they're going to see is the summary, and funders are going to look for consistency in the mission statement and maybe to a grant proposal that you submitted. They want to confirm that your activities are aligned with your stated purpose. Next, they're going to look at the program services accomplishment section. And this is where an organization should clearly communicate the impact of its major programs. Funders are going to look at measurable outcomes and pay really close attention to significant changes in services. Next, we have governance. And here, funders are going to take note of the governance practices in place and pay close attention to whether the board reviews the 990 before it's filed. There's a section for compensation of officers, directors, and key personnel. And funders can assess whether compensation appears to be reasonable. We're, of course, going to look at revenues and expenses, similar to the audited financial statement. How are revenues diversified? Are expenses or the allocations reasonable? Are they consistent with the organization's mission? Of course, we're dealing with funders. We are a charity, so the public support test is very important for public charities. Funders want to make sure the organization is meeting the IRS support test for public support and not relying too heavily on one source. Even without seeing individual donor names, funders can tell whether revenue is being concentrated by looking at public support trends. And then there's supplement information that we provide in the 990, and that's going to give some explanations to answers that were addressed earlier in the 990. We can really get into some detail of our governance and explain any unusual or complex accounting items. So let's walk through these items in a little bit more detail, and we're going to have a screenshot of the actual form from the 990, hopefully to help paint a better picture. So we're going to start with page 1 and part 1. This is that summary snapshot. Of course, it's going to be the first thing that a funder is going to review. It's going to give them a high-level picture of the organization's mission, its finances, and compliance. So a few key items here that funders may focus on. One is the mission statement. Funders want to make sure that the mission aligns with the grant narrative that you provided to them. If it's outdated, that's a red flag. Even if the rest of the form 990 is strong, if we're not keeping that page 1 updated and accurate, it might turn donors off. Clarity. We want to make sure that that mission description is short and clear. We don't want funders flipping from page to page to understand what the organization does. So here's a great example of that. Of the numbers. Obviously, the funders are going to be looking at the numbers that are presented here, and it's really a quick consistency check, making sure that these tie back to the audited financial statement. And really, they should, because often the 990 is prepared by the audit firm. I have seen situations where maybe one firm does the audit and another firm prepares the 990, but from my experience, that's pretty infrequently. All right, so this summary page obviously is going to set the tone for the rest of the 990. And again, we want to make sure there's clarity and consistency. All right, so we're going to move on to page 2. Looking at part 3, this is where funders are going to go to see what the organization actually does and whether it's making a difference. This section highlights your organization's major programs and their impact. Again, funders are looking for clear, plain language descriptions of your services and, when possible, measurable outcomes. Now, measurable doesn't mean really a complicated narrative. It might just be the number of people served, the number of services delivered, or the outcomes achieved during the year. All right, so we have our mission statement, again, concise. This is what we showed in that summary. And then for our program descriptions, this is a great example to see the accomplishments. It clearly explains what the program does, how many people it served, what the outcomes were, and this is all done within a few sentences. In this example, we're also briefly noting some program changes which helps explain the year-to-year differences that I'm sure the funder, if they notice, would want to understand. As hopefully everyone is aware, the 990 is a public document. So there's great news with that. This form, especially this section, this really gives us the opportunity for free marketing, free storytelling. We get to tell what we did, and it's free form. We get to use our words. So too many organizations, I don't think, take advantage of this. But again, just to make sure that message is getting through, we want to keep these narratives concise. We want them to be plain language and clear and focus on the results to really get the funders' attention. All right, we're going to move on to page 6 and part 6. This is where we're going to focus on governance policies. Obviously, funders want to make sure that there's strong oversight in the organization. So some of these policies, they're not required by the IRS, but the IRS does have questions about them. And funders, of course, want to see a yes response to these questions. It signals best practices. Management and the board should review these questions carefully to ensure that they are answering accurately, making sure that there's accountability. Having these policies in place is a signal of strong governance and financial stewardship. So I also want to point out question 11A here. This question is asking whether the organization provided a complete copy of Form 990 to all members of its governing body before filing. Very important for the board members on this call. Have you had the opportunity to review the 990 or look at it before it's filed? I think that's a major part to help with your fiduciary responsibilities. We recommend designating an individual or a committee that's going to conduct a detailed review. They can then share those their thoughts and opinions with the larger body. That could be the treasurer. It could be the finance committee. It could be some board member with relevant experience or expertise, really to serve as that detailed reviewer. So the takeaway here is that we just don't want that there to be policies on paper. We really want to show that there's evidence the board is engaged and informed. On to the next page, page 7, part 7. This is that compensation section. Again, this is for officers, directors, key employees. I think the term they use is highly compensated employees. Funders are going to be reviewing this very closely. They want to look at this to really see who leads the organization and whether some of those individuals are paid or they volunteers. Salaries and reported hours should be reasonable for your organization's size. They are reported on a calendar year basis, even though your organization may have a fiscal year end. We do that because they should be tying directly back to the W-2s and 1099s. Part of the information we report here is how many actual number of hours someone is doing over a week. Responses like it varies or not applicable, that can raise questions from funders. And board members, they're all volunteers, so I think these hours should be realistic. I would imagine that a volunteer board member is not putting 40 hours in per week. On to page 9, part 8. And this is where the organization is going to ask, or the 990 is going to ask about the organization's revenue streams. This section really breaks down all the revenue sources that the organization may have. This includes contributions and grants, earned revenue sources, program service revenue, or other revenues like investment income or fundraising events. Funders are going to look at the section to assess whether the revenue streams are diversified and are they relatively consistent over time. So be prepared to explain significant shifts over year to year, or if there's any unusual other revenue items like unrelated business income. In short, funders use this section to understand how stable and sustainable your funding model really is. The next page is going to be the expenses. And if this looks familiar, it's because it really is hopefully mimicking what they saw in the audited financial statement. The 990 does require us to report on those functions: program management in general and fundraising. So both the audited financial statement and Form 990 obviously are going to require accurate reporting of our functional expenses and how they're allocated. And that really all starts with how expenses are tracked in the accounting system. So we need a good process, a good system for that. Many folks here may be QuickBooks users, and we have many clients on QuickBooks, and we do track expenses by function using the class feature in QuickBooks. If you use QuickBooks and you're not doing that, give us a call. In fact, check out one of our most somewhat recent webinars we did. Again, check it out on our website. It's called Nonprofit Financial Reporting. Build a system, a simple system for complicated needs. And that's really going to get into this issue in some more detail. All right, funders generally expect most resources to support program activities, and they're going to refer to that as the program ratio. And that program ratio is important, but it doesn't tell the whole story. So be prepared to explain yours. As an example, if you're a newer organization, you're probably going to have a higher administrative cost early on. Maybe you're investing into infrastructure like technology or staff training. That can temporarily raise your support cost, but there's going to be some long-term value to that. Another thing to point out for public charities that solicit donations, fundraising expenses should be reported. When you have an organization that does receive contributions and they don't have any expenses in the fundraising column, that's a big red flag. Funders are looking for transparency. They're looking for explanations to potential issues, and hopefully those explanations are really going to make sense and explain what's going on. Schedule A of the 990 is our public support test that provides information about our public charity status, and it shows how the public support is calculated. Key example of public support includes direct donations, grants, membership fees, and gross receipts from volunteer-run fundraising activities. And while completing the Schedule A is probably left to the tax or the 990 preparer, whether that's the audit firm or another outside tax preparer. It's really management and the board that should be monitoring compliance throughout the year to avoid any surprises come year end. So pay close attention to large contributions from individuals or corporations, especially those that could cause fundraising or donations to exceed the 2% threshold. That's reflected here in the chart. Also watch for excessive support from disqualified persons, such as a board member, since those amounts are generally excluded from the public support calculation, the numerator of that ratio. Under our 50C3 category from the IRS code, there is 509A. There's A1 organizations and A2 organizations. For A2 organizations, they have a higher level of earned revenue, so it's important to monitor reliance on investment income and unrelated business income, which generally need to remain below the 33 1/3% threshold. This monitoring matters because if you fail the public support test for 2 consecutive years, those results that could result in the loss of your public charity status and you'll automatically be reclassified as a private foundation. So this is one area where waiting for the year end really could create a problem. If there's issues, it's definitely going to be much harder to fix that as opposed to monitoring this during the year and then being able to address potential issues in real time. Okay, finally, we are at Schedule O. This is the form that allows us to provide additional explanations, maybe some required details that supports some response elsewhere on Form 990. This is where the organization can add narratives and context to help readers understand what's behind the numbers and provide more information to those yes or no questions that were in the previous sections of the 990. Some common examples is explaining governance practices, like how the board reviews Form 990 before it's filed. For instance, an organization might note that the treasurer or finance committee conducts a detailed review, and then the full board is given the opportunity to review and ask questions, and all this happens prior to the filing. Schedule O is used for other things. It can be used to provide details about conflicts of interest, whistleblower, or document retention policies. It might explain how officers and key employees are compensated. It might describe significant changes in revenues or expenses. It's also a place to note unusual grants excluded from our public support calculation, or maybe providing information about required lobbying or fundraising disclosures. And often it can be used to explain differences that might occur between the audit and Form 990. So a tip here is if you are putting something in Schedule O, it's important to reference the specific part and the line number that you're referring to from that 990. And in this example here, when we're talking about our review of the board review of the 990, we start off calling out what question we're addressing. So we're questioning the question from Part 6, line 11A. This way, the reader can easily connect the narrative back to the original question, again, making it very clear for our funders. So when we are providing proactive explanations to our story, it's going to hopefully eliminate the need for the funders to be guessing what's happening. We're telling them right from the beginning. All right, that brings us to another poll question. What is the primary purpose of Schedule O from a funder's perspective? Again, make sure that you hit the submit button here. We're going to go a little quicker now as we're getting close to the top of the hour. So one of these answers, again, I think is the overarching response. All right, so the correct answer would be C. Looks like most people got that. Very good. All right, one final note on the 990. There is a report or a part here, Part 9, that reconciles net assets from, it's called Reconciliation of Net Assets, and it reconciles the activity from the audit to the 990. And that is because sometimes there is differences in the accounting treatment for financial reporting purposes, generally accepted accounting principles, versus the tax treatment, what the IRS treatment is for a particular item. If these occur, this is where we would reflect that difference. I think one of the most common issues or differences that exist is donated services or use of donated facilities. All right. So just to wrap this one section up, just a quick reflection, thinking about maybe there's a problem that or an issue that's within your financial statements, something that the funders probably do see more often than not, but just thinking about what these issues could be, and thinking about how you would explain those in a way that's not defensive. We don't want to justify the issue. We don't want to put spin on it. We want to be providing context. There's always issues or explanations to potential issues. So in the case of low unrestricted cash with large balances in donor restricted net assets, there's an operating deficit, and there's a high percentage of fundraising expenses. All right, that doesn't look too good, but maybe there is a simple explanation. We could be in a situation where we're in the middle of a capital campaign and there's timing delays in other funding. We're making a strategic investment that's, of course, raising costs now in the short term, but it's going to be building long-term sustainability. We're going to have the opportunity in our audited footnotes to talk about that in the financial statements, and we're also going to have Schedule O, the narratives, to provide that insight and explanation on Form 990. So providing that information, that explanation to the funders, is going to prevent them to have, again, try to guess what's happening and probably not get it right. This is a great example of some of the challenges we sometimes see in reviews of financial information, either from the financial statement or the 990. Again, funding, our scenario number 2 here, funding delays. How would we address that? Again, we don't want to be defensive. We don't want to spin it. We want to provide facts, provide some maybe forward-looking information, and tie that to strategy. So a great explanation of funding delays may be that we've incurred higher fundraising costs as we look to diversify revenue. We've identified a problem and we're working on a plan to address it. And we did this because we saw there were funding delays. We're being proactive. We're acting responsibly. And how does that tie to strategy? And then laying out a plan. Hey, maybe the result, we're already seeing some positive results from this in the coming year. So great way to respond to that potential question from a funder. All right, we're going to wrap up some best practices for providing information on the audit and Form 990. And there's really 4 areas that we're going to look at: liquidity, revenue diversification, expense trends, and operating results. We talk about liquidity. We want to make sure that, or what funders are looking at, they want to make sure the organization can meet its short-term obligations and keep up the day-to-day operations running smoothly. If cash does get tight, funders want to know that the organization has it handled. They're really zeroing in on cash and assets that can quickly be converted to cash and how they compare to those short-term liabilities. There's a good ratio of current assets to current liabilities. When assessing liquidity, keep in mind that assets that are not available for general use should not be included in that calculation. These would include things like donor restricted funds, board designated reserves, or assets that have been used as collateral. They're in our statement of financial position, but they can't be used to cover general obligations. If funders ask about deficits, or if there's expected surpluses, what's that impact on future operating cash flow? We want to be transparent. We want to be ready with a clear and honest answer, establishing transparency. That's what we want to do. Revenue diversification means how stable and viable our funding model is over the long term. So having that diversity in revenue across multiple sources helps funders feel more confident about the organization's resilience, what it can withstand. And specifically, they're looking for multiple or varied revenue streams, not leaning too heavily on one single donor, one single grant, or one single funding source. That's a concentration that's probably going to raise some eyebrows. Something to keep in mind, again, restricted revenue can make flexibility look tighter maybe than it is. There's revenue on the paper, but if it's being restricted for a purpose or for time, be upfront about that. Again, we have our audit disclosures. We have Schedule O for providing explanation. And again, funders are making sure the organization isn't overly dependent on one funding source. That could make them vulnerable if there's disruptions to that revenue stream. And again, answering questions confidently, hopefully will put you in good standing with your funders. Expense trends matter, of course, because it shows whether spending patterns actually align with your strategy and long-term sustainability. Rising costs aren't automatically a concern, but they do need to make sense. Funders are going to be looking at total expenses over time, building those trends. Are expenses growing faster than revenue? They're going to be looking at cost allocation methods. Are they reasonable? Are they consistently applied? Now, there may be situations where there's a spike in expenses and there's good reasons. One-time strategic investments into maybe technology or infrastructure, that obviously is going to push up cost in the short term. But as long as you can explain it, talk about what they're for, and how it's going to help the organization in the long term. We should be ready to answer questions about what's driving changes in expenses year over year. Are those increases intentional? Are they temporary? Are they structural? If you can walk through a funder clearly through that, then you're telling the right story. And then finally, operating results. Obviously, they indicate whether the organization is operating efficiently and effectively. Current operations are financially sustainable. It's the bottom line questions you're going to get from funders. Can the organization sustain itself by what it's currently doing? Operating surpluses or deficits. Obviously, if there's trends going one way or another, that's something we have to be ready to answer. And they're going to be funders are really going to be sort of mapping out what those trends are, what's the trajectory of the organization. Hopefully, we can explain any issues that are concerns to our funders. We want to have a plan for growth, a plan for sustainability. As I always say, whenever I talk about nonprofit accounting, budget for a surplus. It's harder to have a surplus if you don't plan for one. But be prepared to explain any issues that, again, our funders are bringing to our attention, and how that ties to mission and our strategic plan. We have one final poll question. For everyone getting CPE, let's get our answers in here quickly. Which of the following might prompt funders to ask questions about during their financial review of a nonprofit? So as you're answering this question, think about what changed. Give people some time to answer, get their questions in. To me, answer B here, a dramatic change in program expense percentage over multiple years. I think that's something that's going to draw attention from funders. All right. So together, our audit in 990 is going to give funders a clear picture of our financial health, governance, and our mission alignment. Funders use these reports to quickly assess whether the organization is stable. It's going to measure its transparency and how well the organization is managed. Again, both documents are going to focus on the four things, the same things: liquidity, revenue diversification, expense trends, and operating results. So if funders can quickly understand these, and you're able to explain the whys, you've done more than comply. You've actually built confidence with your funders. As a takeaway, here is this a reference guide on some of the ratios that funders may use, some metrics that they may sort of measure your results, compare those to other organizations. So really just here as a takeaway for everyone attending today. And I thank you again for joining me. I'm going to stay on for about 10, 15 minutes and address some of the questions in the chat if you'd like to stay on. If not, thank you again for joining me. All right, so I might just be going in the most recent questions asked here, but I'm just going to pick a couple here. Can someone ask, can an organization prepare their own audit or have a board member participate? The answer to that is no. An audit has to be done by a certified public accounting firm that's first licensed to do that, and also one that is independent. So it has to be done by an independent auditor. So someone who works at the organization obviously would not be independent. A board member also would not be independent. Now, an audit may not be required for an organization, and in most states, if your contributed revenue is less than $1 million, there's not going to be a statutory need for an audit. But if you're soliciting donations, I think it's very important to have an audit done. Without an audit, it may be hard for a potential funder to have confidence and rely on those financial statements. Someone asked whether a description in Schedule O of an organization made its governing documents, conflict of interest, and financial statements public during the year. Let's see, describe one, whether, I'm not sure what that question was there, but yes, so there's going to be in the governance section earlier on in the 990, they do ask 3 policy questions. Conflict of interest, whistleblower, and document retention policies. Does the organization have that? So if you don't, that's a good sort of trigger to have the board establish those. But any other policies that you think might help promote transparency, feel free to put those into Schedule O. That is free form, so you can answer and provide insight to any policy questions and governance questions in that section. Someone asks, is there best practice for program percentages? So it really is relative to what type of organization and sort of the tenure of the organization. I always deter there from being a fixed percentage, program percentage, because it really does matter on, I think, more about the percentage. What's more important is sort of the impact. Now, if an organization is only 40% programmatic, there should be a pretty good explanation as to why. But an organization that shows 90% program percentage, I call question to that, because how is the organization handling all the oversight and governance responsibilities, the foundation? So thinking about a for-profit business. Could a for-profit business operate on 10% overhead? I think that would be challenging, even more so for a nonprofit. So a percentage that I think is unrealistic, like 90% programming, is almost as bad as saying a lower percentage of programming. What's important is that we're actually looking at what's being done and are we allocating it properly. All right, there's one here. I have a recent audit financial statements in 990. Someone's just saying that they're going through it and they already have a question for their CPA. And hopefully, if those 2 documents were prepared by the same CPA, they should match. But again, there are some instances where there's different accounting treatment for tax purposes versus financial statement purposes. Someone asked about the 990 EZ. So what we looked at was the long form 990, the 990 EZ is going to have less schedules than what reported here. So every section that we reviewed may not be in the EZ form. And for organizations that have activity under 50,000, I think it is, they actually file what's called the 990N. That's sort of like a postcard. There's really no information provided in that filing. All right. I see there's a follow-up question on releasing of restrictions being viewed as negative. So when we have restricted activities or restricted donations, reporting that on our statement of activities, we are sort of showing what has come in during the current year for restricted donations, and along with any prior restrictions that have not been released yet. That's going to give us our total restricted net assets for the year. And if the organization has met the restricted purpose, or if there was a time restriction, if that time has passed, then we get to release those restrictions. We move it from the with donor restricted column to the without donor restricted column. That is a zero impact on the bottom line. We're just moving it from one revenue column to the other revenue column. So that line zeroes out. What changes is our change in net assets for restricted purposes and unrestricted purposes, but in total, that is a zero effect. So that hopefully should not be viewed as a negative. All right, some other questions here for a couple more minutes. Someone said, I believe we have 9 months after year end to comply with the audit. Why is best practice 90 days? Well, there actually is no any period at all, but best practice is 90 days because the information is, the further away you get from the year end, the more likely that information is stale. And from the auditor standpoint, they have to keep testing subsequent events up until they complete their audit work. So if you were to get your audit done within 90 days, they're only looking at the first 3 months of the new year. If you're going 9 months out, now they're looking at 9 months of activity after the year end to make sure nothing should have been reported in the audit year or there's activities that are affecting the audit results. So from a practical standpoint, we want to get it done sooner. From the funder's perspective, why are we not able to get the audit done? Are there issues? Again, we're trying to address potential questions from funders. Are your books not ready? Do you not know what you're doing? Do you not have a competent CPA? There's a bunch of questions funders are going to just throw out. They may not apply at all, but we want to limit those questions. So best practice is 90 days, but you do want to get it done within a reasonable amount of time. There are reasons that you may have to wait a little bit. There's a tie-in to the 990 though. So we do have the 15th day of the 11th month to file the 990 with all the extensions. If we're going past that, then we're going to get into trouble with the timeliness of our 990. So again, we're just pointing out best practices, but do your best to get it done as soon as possible. Someone's asking about the cost of an audit. I really could not answer that effectively. I would say if you're already working with an auditor or you're looking to have an audit done, if you never had one done before, put out a request for a proposal. I would send that out to a number of CPA firms, let them send their proposals in, do some review of those, and then maybe narrow it down to 2, 3, or 4 finalists, if you will, and then meet with them directly and get an understanding of sort of what their approach is. It's a personal relationship. You're going to want to make sure that you and your auditors are in sort of alignment. You understand one another. Obviously, cost will be a factor, but don't let that be the only factor in selecting an audit firm. All right, we are now at 1:15 Eastern time. I thank you again, everyone who's hanging on here, and our contact information is here if you'd like to follow up with us. And until next time, everyone have a great day. Thank you.